Good morning, ladies and gentlemen, and welcome to the SHANTA Gold Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Eric Zurin. Good morning, sir.
Thank you very much, and good morning, everyone. It's a pleasure to be back on the platform, and today we'll talk a bit about the Singida Gold Mine 5-year plan, as well as our 2023 guidance and a few other pieces of information that are relevant to inform you about today. As I've done in the past, I'll turn the video off for the main presentation, then I'll open it up for, again, the Q&A. So we'll do that now. And here we are. The 5-year plan that we announced today demonstrates the long-term potential for Singida. And when we talk about long-term on site and on the ground, we really talk about 2035, 2040 being the reality of this project, if not longer. And shortly after pouring our first gold 3 months ago at Singida, and following this phase of rapid ramp-up, the site has been performing very well. It is now a cash generator, and we are seeing the benefits of Singida come through our balance sheet. So everything is going at or better than we expected. Singida is contributing to our financial flexibility, and that's allowing us the ability to invest across our portfolio. So today we're guiding for 90 to 98,000 ounces of gold production in 2023. That reflects only 9 months of production from Singida. And overall, we've guided or forecasted about just over 100,000 ounces of gold production on average over the next 5 years. So beginning here on slide 3, the opportunity in front of us today is really SHANTA as the new 100,000 ounce gold producer in Africa with a diversified revenue base and generating significant cash flows. And we believe that this is not being reflected or recognized by the market. So in addition to the around $60 million of EBITDA that our research analysts forecast, we also own the hugely valuable West Kenya project, which is getting all sorts of attention, and one of the highest grading 1 million, which is one of the highest grading 1 million ounce gold projects in Africa. As you can imagine, SHANTA's balance sheet is in excellent condition. We are a dividend payer. We have been for now, it's our 3rd year, and we are fully exposed to the gold price, so no more hedging. On to slide 4, and we have a diversified portfolio of East African gold assets. They're valued, we believe, at just over about $500 million, and that's in comparison to our market cap, which is about $120 million today. So with Singida now in production, SHANTA producing at a rate of 100,000 ounces of gold per year, West Kenya is taking the center stage for unlocking further value in our growth story. Our attractive valuation is supported by this dividend yield of just over 2%, which has been around for a couple of years, and very undemanding market multiples. You can see here EBITDA multiple of just over 2 times. So very attractive entry point for what is a highly cash generative business. Now on to the highlights of today's announcement. You can see here Singida is our second mine, and it is in full production. Over the next 5 years, Singida will contribute on average 34,000 ounces of gold production, taking SHANTA to over 100,000 ounces of group production. Singida delivers healthy margin with cash costs of around $900 an ounce and all-in sustaining of $1,085 an ounce over the next 5 years. And our strategy with Singida is really focused on 3 pillars of optimizing the operations, getting those working and working as best they can, getting the costs down, so keeping our fingers on managing margin and maximizing cash flow. And then the big one is at Singida is maximizing the mine life. And then it's really on this third point here. Singida was designed for future expansion. We have the ability to add a second mill. And the existing 7-year mine life has every possibility of doubling through exploration of this attractive greenstone belt. So remember, only 26% of our resources, so just about a quarter of our resources, are in the reserve category. And there's substantial upside of the existing 660,000 ounces of resources that aren't already in the mine plan. So lots to look forward to, big upside potential. Now on to slide 6, our guidance. And Shanta today is guiding to produce 90 to 98,000 ounces of gold in 2023. That's reflecting only 9 months of production from Singida. At New Luika, we are reiterating 66 to 72,000 ounces of gold at $1,200 to $1,300 an ounce. And on Friday, we completed the first half of the year. So we have a pretty good feel for how that's gone, and confident that we can reiterate today. While at Singida, we're guiding for 24 to 26,000 ounces of gold at $1,300 to $1,400 an ounce. And the costs are slightly higher than New Luika because we are in this period of open pit stripping. The outlook for the next 5 years sees Shanta producing on average 103,000 ounces of gold. That works out to roughly just over $1 billion of revenue over the next 5 years. Imagine that for a company the size of less than 100 million pounds. And most importantly, this excludes, so this 103,000 ounces of gold production excludes any exploration success, reserve additions, and process plant expansion at Singida. So definitely upside from here. Our mining operations are humming very well. Q2 was our first ever quarter with 2 producing mines. And the result of 40 to 50% more gold production has had a huge impact on our cash flows and balance sheet strengthening. And we see that every day as we check the gold production numbers. And certainly as we've now finished the quarter, we're feeling pretty good about our assets. And so I'm looking forward to updating you in the market of our Q2 results around July 20th. Turning to slide 7 and a recap of Shanta's evolution over the last 2 years. So what have we been up to, and how have we gone from then to now? Across the board, operations and profitability are up. You can see here we're now producing more gold than we have ever been in our history. We have 2 mines, we have more gold in the ground, and we generate more cash flow. The gold price is also up, which makes our profitability more attractive. But the opportunity here is that the market is not recognizing the value of our assets and our share price. And I've said this before, and I'll say it again. We know our assets, and our Q2 results will start to demonstrate the same conviction I have and I'm sharing today. And so since August 2021, we've built a new mine. We've increased production by 50%. And we are now on the radar of mining companies because Shanta today has the right size and the right scale to be a bolt-on. And so you can see here, as you remember from last year, we had the approach from the Chinese, and we are certainly on the radar. On slide 8, as most of you already know, Shanta's largest shareholder in June had to dispose of nearly all of their shares. And so this latest update here is as of June 27th for OD, which is now down to 1.1% as of June 27th. And as of June 21st for the remaining, for the balance of our shareholders. Today, Shanta is owned about 50% by retail shareholders. Most of those are in the UK. And my understanding is that we have not had any new TR1 notifications from new shareholders buying because none of those new shareholders have crossed the 3% shareholding threshold. Now, of course, if any of that changes or we are made aware of anything, we will update the market as we receive the information. But today, the register is stable we've certainly seen our largest shareholder go through its own period of change, and we believe that is now behind us. So Singida, in full production and operations progressing very well. Singida is a really neat asset for Shanta's Tanzanian portfolio. It is certainly adds production. It shares overheads. We have now a center of excellence across our 2 Tanzanian mines, and it's a great addition to what we've been doing for nearly 20 years in country. The mine in Singida is hosted in the Lake Victoria Greenstone Goldfield, which is home to numerous Tier 1 global gold deposits like Geita Gold Mines, North Mara, and Bulyanhulu, owned by Barrick and AngloGold. We are mining by way of open pit contractor with a plant that is sized at 1,000 tons per day of throughput. So it's a single mill recovering gold by gravity and leaching. And to put that in context, our New Luika gold plant has a capacity of about 2,500 tons per day. So Singida is about 40% of the size of New Luika. Now there's an identifiable path to double that throughput to 2,000 tons per day by way of a second mill, upgrading pumps, 2 new tanks, and all of that costs a meager $6.5 million. And so that's really the prize at Singida, is to add new reserves and double throughput for what is a very manageable capital investment. And so we're excited by that. And by the end of Q3, we should have the drill rig or drill rigs turning at Singida. Now, remember, all of Singida's plant and equipment is brand new. And over the next 5 years, Shanta or Singida will produce 34,000 ounces of gold per year on average grades of between 3 to 3.5 grams per ton. On slide 11, we cover some of the costs and some high-level numbers here. You can see the operating costs are $888 per ounce over the 5-year plan, and the all-in sustaining costs are $1,085 per ounce over that plan period. So this means Singida generates about $800 per ounce of margin on 34,000 ounces of gold production. And remember, it only costs us about $40 million to build Singida, and Singida will be around for, I'm sure, 7 to 15 years at a minimum. So this is a huge potential for Shanta because of the high margin, the longevity of the deposit, and the fact that we'll have our capital recovered relatively quickly. Over the next 18 months, we will be further opening up the Gold Tree open pit, and that'll result in higher than average costs, as you can see on the previous page in the stripping ratio. But that'll normalize in about 18 months, and all-in sustaining costs will drop then down to about $950 per ounce. So very, very attractive cost profile. On slide 12, we outline the areas for potential upside that we are monitoring closely. Recall, first gold pour took place on March 30th, so about 3 months ago. And we've now announced, and we announced up until April 22nd that we produced about 2,200 ounces of gold. So roughly about 100 ounces a day. Now on the left-hand side, where we are today is we've outlined the assumptions we made in our plans before we went into construction. And these include things like the recovery rates at 91%, the amount of gold that's recovered by gravity as opposed to leaching, which is about 40%, the purity of that gold, the amount of deleterious elements and other metals at 80%, and then of course the upside through the reserve and resources. Now, excuse me, the upside potential here on the right-hand side are areas we've identified that would add direct value to the Singida operations and increase cash flows. And so these are some of the things that we'll be updating you and our fellow investors on later this month when we update our Q2 results. But suffice to say, we're feeling pretty good about some of these areas that we're monitoring closely. On slide 13, we outline our exploration plans. I reiterate that Singida is largely underexplored. It's ripe for reserve additions through exploration, and work is ongoing to plan for these programs starting at the end of Q3 drilling. So starting for drilling at the end of Q3. Now, there are a number of targets identified, including the extension of the Gold Tree pit into Vivian and Gem, which has already seen a number of historical drill holes near surface with great mineralization that isn't part of the mine plan and needs follow-up. So lots to look forward to there. And remember, the exploration strategy at Singida has always been to fund drilling from Singida cash flows. These assets have to be standalone profit centers, and they need to substantiate their own existence. And so Singida is already doing that, and gives us that firepower to invest capital into reserve additions. On slides 14 and 15, just to recap, and then we'll open up to some Q&A. Shanta is now a 100,000 ounce gold producer, and we'll demonstrate that in our upcoming announcements. The value of our assets and from our cash flows is not being recognized in the market, and that really is the opportunity today. And in fact, drilling is ongoing at Nuluika, West Kenya, and soon to be Singida, as you can see on this page. And that typically has been the best source of value for Shanta. So in terms of our next identifiable news item, it really is our Q2 results in about 2.5 weeks' time. And we'll be announcing Shanta's first ever quarter as a 2-mine producer. So really exciting, huge kind of threshold to reach, and a lot of really good energy coming out of our teams in Tanzania. So with that, I'll hand back to the operator and open up to any Q&A.
Eric, thank you very much, and that's great. Thank you very much for your presentation this morning as well. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Eric, as you can see in the Q&A tab, we have received a number of questions throughout your presentation this morning. Thank you to all of those on the call for taking the time to submit their questions. Eric, if I could just hand back to you to respond to those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thanks very much. And as I've said, as I've done before, and I'll do it again today, I'll answer all questions without exception. So our first question comes in from Tim, who's asked, can you comment on the OD overhang? So we have done that. We announced an RNS released an RNS on Friday, which had disclosed OD down to about 1% shareholding, which is not an overhang. So that closes that matter. Ramon has asked, do you have any explanation for the significant share price drop? Is it just OD selling? Indeed, I'm certainly not a market expert, but I look at the facts, and when I see 300 million shares traded in 2 or 3 weeks in Shanta Gold shares on the AIM, and our largest shareholder has sold, had been selling, that's typically more than the AIM market can handle. And when there's more sellers than there are buyers, the share price goes down. Now, ironically, this happens to be the strongest period ever for Shanta's operations, and it certainly, you have these unrelated events, where effectively someone needs to sell, which is, that's their prerogative and their business. But what I can tell you, and my job is to deliver a very good equity story, but also real value from our operations. And I'm a big believer in fundamental value, that over time, value is recognized when it's been created. So this is a great opportunity to buy shares. Alexander has asked, good morning, could you please explain if the second ball mill is included in the 5-year production plan? Because the uplift in production seems low compared to doubling of the throughput. So Alexander, no, the second ball mill is not included in those forecasts. The way to think about that is, it's just depending on what we find in terms of exploration, we would, we could aim to double the milling throughput in the plant for $6.5 million. And then that would allow us a bit more flexibility on grade. And so if we kept the grade the same and we doubled the throughput, the gold production would double as well. If the throughput doubled and the grade dropped a little bit, then the gold production would increase in proportion with that grade. So the way to think of it is if we do go ahead with that expansion plan, 34,000 ounces per year of gold production over the next 5 years, could easily become 50 or 60,000 ounces, which would be a certain a big game changer for Singida and certainly very valuable to Shanta. Stevens asks, good morning. Given the almost constantly stated belief that the market is not recognized, that the value of Shanta is not recognized by the market, is there a reason that Shanta is yet to begin a share buyback program? With cash flow where it is, Shanta has an opportunity to remove the shares issued to Barrick from West Kenya. Well, I'll start with that last point first. Barrick sold their shares issued for West Kenya. They sold those back 3 years ago. So Barrick's not a shareholder. But I tend to agree with you, Stephen, that Shanta is undervalued. It's not recognized by the market, and particularly on cash flow multiples, which are undeniable. So what we did 2.5 years ago, we started to pay a dividend in small steps. But remember, we were building a mine in that period. And when you're building a mine, you certainly want to maintain your financial flexibility. And so we weren't in a position to look at other forms of returning capital to shareholders. Now, that's changed because Singida is built, commissioned, and producing, and it's producing a lot of cash flow. And so that begs the question: then what do you do with the cash? And all these nice things to discuss with the board. But it certainly takes time to build a mine, to get it to the point where it's producing and reliable and sustainable. And I think we are at that point now. So we'll have to consider what we do with the cash thereafter. When you say the company will be debt-free within 6 months, can you confirm that means by December this year? Now, what we did is we certainly did footnote that. We said it would be net debt-free. So it would have more cash than it does debt. That's our belief, but it was referenced to a Liberum research estimate. So it's certainly, Shanta does not provide forecasts in terms of balance sheet, but we can certainly review other forecasts and take a view. And so when we talk about in 6 months' time, that's right. That would be 6 months from today would be the end of 2023. And there's, if the gold price holds and production does what it does, I wouldn't disagree that Shanta could be net cash, so more cash than debt. But again, you'll have a feel for what that looks like in 2.5 weeks' time when we announce our balance sheet. Then I haven't actually seen it myself, the latest balance sheet numbers, so I don't even know. But certainly have seen quite a few gold sales over the period, last 90 days, and things are going pretty well. Anthony's asked, you referred to Shanta as becoming an attractive bolt-on. How important is this for Shanta's future? M&A is not part of our strategy other than to look at acquisition opportunities. What I'm saying is that Shanta's profile today, like many other junior mining companies who trade at very attractive valuation multiples, could be argued to be an attractive bolt-on to another mining company. Now, I certainly cannot control that, and we're busy spending our time delivering value and delivering gold from our operations, doing that safely and setting out our strategic plans. If the animal spirits change and Shanta does fall into that category, of course, we'll consider all the options. Camille has asked, could you highlight the balance sheet projection for this year? Are you going to propose an increase in the next interim dividend or share buyback? So we don't have projections for the balance sheet. What I could say is that now that Singida's gone from a cash use to a cash source. So Singida is generating cash as opposed to consuming investment. The profile of Shanta has really changed. It's we now have two producing gold mines generating, give or take $200 million of revenue a year, and that's pretty attractive. That's a lot of cash flow. If you can keep the costs in line and the capital allocation smart. So we're not. I don't have any plans. It's really a board decision. Talk about more dividends or share buybacks. It's all balanced with respect to our capital needs, and and that's the way we look at it. SFAC has asked, did Eric mention a date for the Q2 results? I did. We're tentatively planning for, I think it's Thursday, July 20th. But of course, that can change. But we just planned it around our own needs within within what we're doing within the company. So possibly around July 20th. But don't hold me to it. Peter has said, how would you achieve higher recovery rates at Singida? It's really interesting, and it's all linked to. It's a good question. It's all linked to gold purity, the amount of gravity, and then of course how the processing plant is operating. And so when you have more gold being recovered from gravity, so effectively that's the step before it goes into the leaching. It basically means that there's less gold competing in the leaching tanks to be recovered. And so overall, you can lift, the recoveries lift because it's just more efficient. And so in terms of gravity recovery, we initially planned for 40%, which led to a 91% recovery estimate. And I probably wouldn't be saying this if I didn't think it was encouraging from what we've seen so far. So again, I won't put any numbers to it until it's official. But we're really encouraged by only 3 months in how well Singida processing plant is operating. And then of course the gold purity, that's the way to think of that is when you pour a doré bar, what percentage of that is gold? At New Luica, it's majority silver, believe it or not. So the gold purity there is around 40 to 45%. Whereas Singida, we planned for about 80%. And again, if it's higher than that, then you would find that the recoveries would be better because there would be less materials, less non-gold materials in the circuit. Hopefully that explains that. Ian has asked, could you inform the market on progress on replacing or the succession for CEO? Yes, of course, there's an ongoing process and a lot of great candidates. And I suspect we'll have just a kind of a holding update, short holding update in our Q2 results. But my intention and my commitment is to make sure that there's a smooth transition to anyone who comes in. I'm a shareholder, and I would want nothing more than to see a great successor take over from me. James has said, can you please comment on the lack of any recent director buying given the valuation disparity? Of course, James, and it's really interesting, having been on the inside, is that over the last 6 years, and it's very common for most companies, directors and management, I would say, are more often than not prevented from buying or selling, and it's often because of the information that I have, which would put me at an advantage to the market. Yeah, so I can't really say much more than that. I mean, one would argue I have obviously knowledge of what the Q2 results have been, and you haven't. But anyway, often what we talk to our nomads about this, at length, and often we shy on the area of to be conservative and not to be perceived as doing something that is disingenuous, because conflicts are often mostly perceived. It's about perception as opposed to actual. So what I can say is, hopefully you can get it from my tone, that we're pleased with how things are going at the mines, and we're encouraged by what we've created at Singida. Ian's asked, do you regard New Luika's best days behind us? Declining discoveries, lower grades, higher strip. If not, why not? Well, in fact, I don't, because at New Luika, we've now gone into this. We're in two areas predominantly this year. One is the Luika Underground, which is effectively a relatively new underground deposit. It's the kind of cousin to Bohemia Creek. And we're seeing very consistent grades. The stopes are nice and wide. The host rock is competent. And it's treated us well, particularly this quarter. I mean, we've had very steady operations there, and I won't give you the number, but every month has been effectively the same as the last during this quarter, which is good. You want in mining, you want consistency and stability. You don't want a lot of volatility, and so we're very pleased by that. And I think in July or August we'll be drilling from Luika Underground to test at depth to see if in fact the resources continue at depth, and so that would give us more life and more years. Now, of course, we're also drilling and mining at the Elizabeth Hill deposit, and that's open pit mining, and we've been drilling there, and we believe that pit extends both along strike and at depth, and this is why we're drilling. So, it's funny, if I could reverse 5 years ago, I probably would have had the same question, and New Luika is what it is. It is your typical five-year mine plan, which continues to roll for 5 years on an annual basis. Alberts has asked, with the bright prospects you have described over this webinar coinciding with the drop in the share price, would you not want to reconsider your plan to leave, or would you want to buy more shares? Albert, I appreciate that comment. I've made my decision. SHANTA is a great company. It really is. It generates a lot of cash flow. It's very exciting, has a fantastic culture. West Kenya is a real shining star in the sky for SHANTA. And I really believe that companies should have rejuvenate teams. And I think that's a great basis to leave. I mean, I think SHANTA has never been producing more gold than we are today, and that is seriously encouraging. So we're pleased with how that's going. West Kenya, Ian's asked, West Kenya is a great opportunity, but also great cost. What's your ballpark feeling for the likely total costs? Less than 100 million. Maybe the company can take it on itself, 200 to 300 in case of JV funding. It's an interesting one, and we're constantly going through scenarios, Ian, on West Kenya. And, the latest one, we'll provide a formal update when we're ready. But the latest plan, which we've looked at now for the last couple months, we had this workshop internally at West Kenya. And Rimula, which is the second camp, or really the first camp now at West Kenya, looks like a great starting point for a number of reasons. One is it's open pit mining. Two is which means it's a lot less risky than underground mining. Three, the open pit mining grades at Rimula are very attractive. I think the mineable grade is about 3.5 grams, if not higher, 3.7. So we're pretty encouraged by Rimula. It's also a much lower cost way to get into production at West Kenya. We think it's roughly about 125 million. So 100 to 140 is the target, but we're doing more work on that. And it looks like a much bigger version than Singida. And so guess what? We have the Singida construction team now looking at the Rimula plans and trying to move that forward. So Rimula could be the starter, a hub and spoke type setup that we could fund ourselves through debt and possible JV partnerships, as you say, or however we look at it, cash flow as well. And then of course we have the Kakamega deposit, which could be a high grade sweetener to Rimula. So that's how we're thinking of it. When we're ready, we'll share some updated numbers with the market. Albert has asked, the market does not seem to recognize West Kenya. Is there a reason, such as a great area. Is there no chance to get a mining license? Absolutely not. In fact, we're doing just that. We're currently putting together our indicative feasibility study to get it fully permitted, and that's kind of the plan we're taking. You have to obviously have a target, and that target looks to be like the Rumula camp as a starting point. Alexander has asked, no further questions. Just wanted to take the chance to say thank you for your excellent leadership. I'm very sorry to see you leave. Best of luck in the future. Thanks very much, Alexander. Appreciate that. Michael has asked, could you quickly overview the near-term expected news flow from West Kenya? Absolutely. In the near term, we will have exploration drilling results, and that's really the near term. In terms of the medium term, I would say between now and the end of the year, give or take, we'll have certainly an update out on plans for where we see the scope of the feasibility, so which mining area, and then possibly an updated resource estimate. Sam M has said, your slides showed a sharp fall in production at New Luiki Gold Mine in 2027. Can you explain what assumptions were contained in this? The way to think of it, Sam, is that every year we do more drilling and we replace reserves. And so when you kind of look at a 5-year plan, this assumes there's no more drilling, no more exploration, no more reserve additions, which I find would be very hard to believe. And so for the sake of completeness, we showed a 5-year plan, 2023 to 2027. And then we footnoted that in 2027, it doesn't include any reserve additions, which is what we're drilling right now. So I wouldn't pay too much attention to those far distant numbers. Mazin has asked, any concerns re-impact from future tax political changes in Tanzania? Are the VAT issues any clearer? We've been operating in Tanzania for 20 years. I've been there for 10. I've been in this role for 6. And we're very happy with how things go there in Tanzania. The government's supportive. They have a long history of mining experience. And we work collaboratively and supportively to the government, and we expect the same in return. And so in terms of VAT, we have ongoing VAT funds. So the current VAT, I think we're due $6.5 million this month. We thought we would get it at the end of June, but it didn't come. And so that's coming through. In terms of future tax political changes, it's business as usual in Tanzania. So we're working with the government, not against them. Camille has asked, sorry, Eric, it's a personal question. Are you aspiring to be an independent director for Shanta? As you know, a substantial amount of as you own a substantial amount of shares, I think the company still needs your support. Thank you very much, Camille. I appreciate that. I don't have any plans to stay on the board. Of course, I think it becomes sometimes a little bit busy if you have a former CEO who remains on the board. Often you get too many CEOs at the board meetings. So appreciate your comment, and I may follow Shanta from a distance. Ian, I might just say 2 or 3 more, then we'll keep running on here. I'll stop with Neil. So we have 4 more questions. Ian has asked, clearly you cannot hold to this, but are you intending to keep your shares when you leave? Expression of confidence in the new management. Of course, I mean, I'm not selling at these prices because I think I can see that there's a lot of upside from here. So yes, is the reality. Strip ratio at Rumula. Good question, Ian. I believe it's around 13-1, but I'd have to check. 13-1 is relatively high. 3.5 grams open pit is very attractive. Stephen D, do you have a sense range as to how much volume Rumula could produce? Yes. I mean, if we talked about 1,500 tons a day, 3.5 grams, possibly a bit slightly better grade, possibly up to 2,000 tons. I mean, we don't have any. We're not landed on anything, but it would be sort of, I think, slightly smaller than New Luika and much bigger than Singida is probably the way to think of it. And when we think of Rumule, it's really the starting point. It's West Kenya 1.0, and then from there you build. You add additional throughput capacity. You go on to Kakamega. Rumule is one of 5 or 6 different deposits within 5 kilometers. So there's this hub and spoke type of setup there, which is what's attractive. Finally, Neil has said, "Great job, Eric. Thanks for developing Shanta over the last few years. Good luck on whatever your new challenge you take." Thank you very much, Neil. I appreciate that. And I appreciate all of your support and taking the time to listen to me, because I think Shanta is a great story and you should listen, because if you listen, you will hopefully find out why you should consider this as one of the top investments on AIM. So thank you very much.
Eric, that's great. And thank you very much indeed for being so generous of your time then addressing all of those questions that came in from investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Shanta Gold Limited, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.